Of all the tools in technical analysis, the humble trend line might be the most used and the most argued about. It is just a straight line drawn along the edge of a trend, and yet how exactly you draw it sparks genuine debate. Today we learn to draw one properly, and we settle the classic question Micha tackles head-on. Do you draw it from the wicks or for the closing prices? Let's start with what a trend line even is, because the idea is wonderfully simple. In an uptrend, the price makes a series of higher lows, each dip stopping a little higher than the last. If you lay a straight line touching those rising lows from underneath, you get an uptrend line. It slopes up, and it acts as a moving floor, a line of support the price keeps bouncing up from. A downtrend line is just a mirror image. In a downtrend, the price makes lower highs, each bounce failing a little lower than the one before. Connect those falling highs with a straight line from above this time, and you have a downtrend line. It slopes down, and it acts as a ceiling, a line of resistance that keeps rejecting the price every time it tries to rally. So a trend line does two beautiful things at once. It makes the trend visible and undeniable, and it gives you a precise, moving level to watch. As long as the price respects the line, the trend is intact. The real drama comes later, when the price finally punches through it. But here is where the argument begins, and it is the whole point of this lesson. When you anchor your line to those highs and lows, which part of the candle do you actually touch? Remember, each candle has a body, showing the open and the close, and thin wicks poking out, showing the absolute high and low of the session. So do you draw your line along the very tips of the wicks, or along the edges of the bodies, the closing prices? This is the wick-versus-close debate. Let's make the case for the wicks first. The wicks represent the real extremes, the exact points where the price was pushed to its limit and then violently rejected. A buyer or seller who drew a line in the sand did it there, at the wick. Drawing from the wicks means your line respects every single touch, every emotional extreme the market actually reached. Nothing gets ignored. Now the case for the closing prices. The close is widely considered the most important price of the day because it is where the battle finally settled after all the intraday noise calmed down. A single wick can be a brief, panicky spike that gets instantly reversed, an outlier that does not really represent the trend. Drawing from the closes filters out those spikes and gives you a cleaner, calmer line built on where the price truly committed, not just where it briefly flinched. So which wins? The honest answer Micha gives is that both are legitimate and neither is sacred. Many traders prefer closing prices precisely because they ignore the misleading spikes. Others insist the wicks tell the real story of where supply and demand drew their battle lines. The single most important rule is simply this: be consistent. Pick one method and apply it the same way every time. Because a line drawn from wicks here and closes, there's just a line you have bent to fit what you already wanted to see. Now a few rules for drawing one that actually means something. You need at least 2 points to draw any line, but it takes a third touch, where the price returns to the line and respects it again, to truly confirm that the trend line is real and not just a coincidence. The more times the price has bounced off it, the more significant and respected that line becomes. Pay attention to the angle as well. A very steep trend line, rising at a near vertical sprint, is fragile and almost always breaks quickly because no trend can climb that fast for long. A gentler, more gradual line is far more sustainable and trustworthy. And when a long-respected trend line finally does break, that break itself is one of the most watched signals in all of charting, often the first real clue that the trend is changing. And now the honest caveats we never skip. A trend line is, in the end, somewhat subjective. Two skilled people could draw slightly different lines on the very same chart, and you will often have to redraw yours as the price evolves. It describes the trend, it does not predict the future, and a break does not guarantee anything. It only raises the odds. And of course, the long-term index investor drawing no lines at all, simply buying every month and holding, quietly does just fine without ever touching this tool. So look back at that simple straight line. You now know how to build it. Connect the higher lows from below in an uptrend or the lower highs from above in a downtrend. Choose wicks for every extreme, or closes for a calmer signal. And then, above all, stay consistent. Demand a third touch, respect the angle, and watch for the break. I'll see you in the next one, where we look at why stocks so often reverse right after a gap fills. Until then, keep it simple and draw your lines with a steady hand.